The US dollar's share of global foreign exchange reserves has fallen from approximately 71% in 2001 to roughly 57-58% by late 2025. That's a 13-14 percentage point decline over 24 years, representing approximately $1.52 trillion in reduced dollar holdings by central banks worldwide. Not a sudden crash, not a dramatic abandonment, but a relentless accelerating erosion that throughout 2023-2025 has been happening at roughly 1-2 percentage points annually, double or triple the pace of the previous 2 decades. And here's what makes this absolutely critical as we close out 2025. This isn't random drift or natural diversification. This is coordinated strategy by China and Russia throughout 2022-2025 to systematically build alternative financial infrastructure that allows global trade to function without dollars, and to actively pressure countries across Asia, Africa, Middle East, and Latin America to shift away from dollar dependence, not just reducing their own dollar exposure, but constructing an entire parallel global financial system that could eventually rival or replace dollar-based order that's existed since 1944. Let me show you exactly what China and Russia have built throughout 2022-2025, because the infrastructure reveals how serious this challenge is. China's CIPS payment system, launched in 2015 but dramatically expanded throughout 2022-2025, now processes approximately $25 to $30 trillion in transactions annually by late 2025. This is China's alternative to SWIFT, the dollar-based messaging system that banks use globally for international payments. CIPS throughout 2024 through 2025 connects over 400 financial institutions across 100-plus countries. Major banks in Asia, Middle East, Africa, and even some European banks have CIPS connectivity as backup or alternative to SWIFT. Transaction volumes throughout 2024-2025 have been growing at 35-40% annually, indicating rapid adoption beyond just China-related trade. What CIPS enables throughout 2025 is simple but revolutionary. 2 banks anywhere in the world can settle transactions in yuan without touching dollar systems. Chinese company can pay Brazilian supplier in yuan through CIPS. Saudi Arabia can pay Russia in yuan through CIPS. India can pay UAE in yuan through CIPS. None of these transactions require dollars, dollar correspondent banking, or U.S. financial system involvement. Russia's contribution throughout 2022-2025 has been SPFS, Russia's domestic payment system, plus bilateral currency arrangements with dozens of countries enabling ruble trade. Russia throughout 2022-2025 has signed currency swap agreements with China, India, Iran, UAE, and numerous other countries totaling hundreds of billions in non-dollar trade capacity. Russia-China trade worth approximately $240 billion annually. As of 2024-2025, occurs almost entirely in rubles and yuan with $0. Russia-India trade exceeding $50 billion annually occurs largely in rupees and rubles. Russia-Iran, Russia-Turkey, Russia-UAE all increasingly conduct trade in local currencies rather than dollars. Throughout 2024-2025, Russia has been forcing remaining trade partners to accept rubles by requiring ruble payment for commodities. Countries wanting Russian oil, gas, grain, metals, and fertilizer throughout 2024-2025 have been developing ruble payment capabilities because Russia won't accept dollars for many transactions. BRICS payment system, announced throughout 2023-2024 and partially operationalized in 2025, is the multilateral framework that connects these bilateral arrangements. BRICS Bridge platform allows transactions between member countries, Brazil, Russia, India, China, South Africa, plus new members Saudi Arabia, UAE, Egypt, Ethiopia, Iran, in local currencies without dollar intermediation. By late 2025, BRICS Bridge is processing billions in monthly transactions. While still small compared to global trade volumes, growth rate throughout 2025 is extraordinary, doubling or tripling every few months as more countries connect and more transaction types are enabled. Now let me explain what pushing global markets into post-dollar future actually means in practice throughout 2024-2025. It's not that dollars disappear or that SWIFT shuts down. It's that for growing percentage of global trade, currently maybe 15-20%, but accelerating, dollars are optional rather than mandatory. Oil trade is the most visible example. Throughout 2024-2025, approximately 25-30% of Saudi oil exports are priced and settled in non-dollar currencies, primarily yuan. UAE, Russia, Iran, and other producers are following similar patterns. Roughly 15-20% of global oil trade by late 2025 occurs in non-dollar currencies, a massive shift from 2 to 3% just 5 years earlier. When oil can be bought without dollars, countries don't need to hold as many dollar reserves. Central banks throughout 2024-2025 globally have been reducing dollar reserve shares and increasing gold, yuan, and other alternatives. Every percentage point reduction in dollar reserves represents roughly 100 to 150 billion in reduced dollar demand globally. Commodity trade more broadly throughout 2024-2025 has been shifting toward non-dollar settlement. Russia forces ruble payment for its commodity exports. China increasingly accepts yuan for commodity imports. Brazil and Argentina throughout 2024-2025 have been settling bilateral trade in their own currencies. Even smaller transactions between developing countries throughout 2024-2025 increasingly bypass dollars using bilateral arrangements or BRICS infrastructure. Manufacturing trade throughout 2024-2025 between Asian countries increasingly occurs in yuan or local currencies. When Chinese company buys components from Vietnamese supplier, transaction might occur in yuan rather than dollars. When Korean company sells electronics to Indian buyer, transaction might occur in rupees rather than dollars. Each transaction that doesn't use dollars represents erosion of dollars' role. The cumulative effect throughout 2024-2025 is that global trade worth trillions annually that used to require dollars now doesn't. This doesn't crash dollar immediately because $36+ trillion U.S. economy and deep U.S. financial markets still create enormous dollar demand. But structural support from mandatory dollar use in trade is eroding month by month throughout 2025. Subscribe to this channel if you want continued coverage of dollar decline through 2026, because mainstream U.S. media throughout 2025 has been minimizing the significance to avoid triggering dollar panic. Now let me show you what specific countries have been doing throughout 2024-2025 to reduce dollar dependence. China, throughout 2024-2025, has reduced U.S. Treasury holdings from approximately $850 billion to roughly $775 billion, selling $75 to $100 billion out in treasuries, while simultaneously buying gold, building CIPS infrastructure, and expanding yuan currency swaps. Chinese currency swaps with 40+ countries now total approximately $600+ billion, providing yuan liquidity globally. These swaps throughout 2024-2025 allow countries to trade with China in yuan without needing to acquire yuan through dollar exchange. Direct yuan access reduces dollar intermediation and dollar demand. Russia, throughout 2022-2025, has essentially eliminated dollar use from its international trade. Russian foreign exchange reserves held in dollars were frozen in 2022, teaching Russia that dollar assets aren't safe. Russia, throughout 2023-2025, has held reserves primarily in yuan, gold, and other currencies while conducting zero or minimal dollar trade. Saudi Arabia, throughout 2024-2025, has reduced U.S. Treasury holdings from historical levels around 150 to 180 billion to approximately 100 to 120 billion dollars. Simultaneously, Saudi Arabia, throughout 2024-2025, has dramatically increased yuan holdings, gold reserves, and euro assets as part of diversification strategy. Saudi acceptance of yuan for 25-30% of oil sales throughout 2024-2025 has been most visible part of Saudi de-dollarization, but reserve shifts are equally significant. Saudi Arabia throughout 2025 holds tens of billions in yuan reserves and hundreds of tons of gold purchased over past few years to reduce dollar concentration. India throughout 2024-2025 has maintained large dollar reserves due to trade requirements, but has been developing rupee trade arrangements with Russia, UAE, and others to reduce dollar dependence at margins. Indian rupee-ruble trade mechanisms process billions monthly, reducing dollar transactions. UAE throughout 2024-2025 has positioned itself as regional hub for yuan clearing and non-dollar trade. UAE accepts yuan for oil sales to China, processes billions in yuan-denominated transactions through Dubai financial centers, and promotes itself as bridge between Western and Eastern financial systems. Brazil throughout 2024-2025 has been advocating for and implementing non-dollar trade with China, Argentina, and other partners. Brazilian-Chinese trade exceeding $150 billion annually increasingly occurs in yuan or reais rather than dollars. Brazilian President Lula throughout 2024-2025 has been openly calling for end of dollar dominance in international trade. ASEAN countries throughout 2024-2025 have been discussing and partially implementing local currency settlement for intra-regional trade. When Thailand trades with Indonesia or Malaysia with Vietnam, transactions increasingly occur in local currencies rather than dollars, reducing dollar demand across Southeast Asia. Let me explain what U.S. power collapse means beyond just currency shifts. Dollar dominance throughout 1944-2020 gave U.S. extraordinary advantages: ability to borrow cheaply and own currency regardless of debt levels, ability to run trade deficits without consequences because foreign countries needed dollars, ability to impose sanctions by cutting adversaries off from dollar-based financial system, ability to fund military and global presence through deficit spending that other countries finance by holding dollar reserves. Throughout 2024-2025, all of these advantages are eroding. U.S. government debt is approximately $36 trillion as of late 2025. Interest rates throughout 2024-2025 have remained elevated at 4 to 5%, partly because foreign demand for treasuries has weakened as central banks reduce dollar reserves. Higher rates mean U.S. government throughout 2024-2025 is paying over $1.1 trillion annually in interest, roughly 17% of federal revenue. If dollar decline continues through 2026-2027 and Treasury yields rise to 5 to 6% to attract buyers, annual interest costs could approach $1.6 to $1.8 trillion by 2027. At those levels, interest payments would consume 20% plus of federal revenue, forcing fiscal crisis requiring massive spending cuts or tax increases that are politically nearly impossible. U.S. trade deficit throughout 2024-2025 runs approximately $900 billion annually. Historically, this was financed easily because global dollar demand meant foreign countries accumulated dollars that they recycled into U.S. assets. Throughout 2025, foreign appetite for dollar assets is weakening as central banks diversify reserves and as alternative payment systems allow trade without accumulating dollars. If foreign financing of U.S. trade deficit becomes difficult throughout 2026-2027, U.S. would face painful adjustment, recession reducing imports, dollar depreciation making imports expensive, or forced reduction in living standards as Americans can't afford as many foreign goods. U.S. sanctions power throughout 2024-2025 has been eroding as countries develop alternatives to dollar systems. When U.S. sanctioned Russia in 2022, Russia adapted by building non-dollar trade. When U.S. sanctioned Iran, Iran developed sanctions evasion networks using yuan and other currencies. Throughout 2024-2025, U.S. threats to sanctioned countries are less effective because countries know alternatives exist. China can't be sanctioned with dollar cutoff because China has alternatives. Saudi Arabia can't be meaningfully sanctioned. India won't comply with sanctions that hurt Indian interests. U.S. sanctions power throughout 2024-2025 works only against small countries without alternatives. a major reduction from previous era when dollar cutoff was devastating to any country. U.S. military power throughout 2024-2025 is still formidable, but increasingly strained by fiscal constraints. Defense spending around $850–900 billion annually is sustainable when U.S. can borrow cheaply. But if interest costs rise to $1.6 to $1.8 trillion and fiscal crisis forces budget cuts, defense spending will face pressure. U.S. global military presence throughout 2026-2030 might need to contract as fiscal reality constrains what U.S. can afford. Now let me show you what China and Russia's endgame appears to be based on actions throughout 2022-2025. Complete goal isn't necessarily destroying dollar or replacing it with yuan as sole reserve currency. Goal is creating multipolar currency system where dollar is one among several major currencies rather than overwhelmingly dominant. In this system, throughout 2030s, maybe 40–45% of global reserves are dollars, 20–25% are yuan, 15–20% are euros, 10–15% are gold, and remainder are various other currencies. Trade occurs in whatever currency is convenient for the parties: yuan for Asia trade, euros for European trade, dollars for America's trade, local currencies for bilateral arrangements. This system throughout 2030s wouldn't eliminate U.S. power, but would eliminate U.S. privilege. U.S. would be large, important economy, but wouldn't have special advantages from currency dominance. U.S. couldn't run unlimited deficits, couldn't borrow as cheaply, couldn't sanction as effectively, couldn't fund military presence as easily. China in this system throughout 2030s would have much greater influence because yuan would be major reserve and trade currency. China could influence regional countries through currency leverage. China could fund development through yuan-denominated lending. China's financial system would be central to Asian trade in ways that challenge U.S. financial dominance. Russia in this system throughout 2030s would benefit from having alternative to dollar that can't be frozen or weaponized by U.S. Russia could trade freely with willing partners without needing dollar access. Russia could avoid Western sanctions through alternative payment systems. Throughout 2024-2025, infrastructure being built by China and Russia, CIPS, currency swaps, BRICS bridge, bilateral arrangements, all support this multipolar vision. Every month throughout 2025, infrastructure gets more sophisticated, more countries connect, more transactions flow through non-dollar systems. Let me tell you what happens if current trajectory continues through 2026-2030. Dollar's reserve share could fall from current 57–58% to approximately 48–52% by 2030, meaning for first time since World War II, majority of global reserves would be non-dollar assets. This would formally end dollar hegemony and usher in multipolar currency era. U.S. throughout 2026-2030 would face fiscal crisis as borrowing costs rise and foreign financing diminishes. Budget choices throughout late 2020s would be brutal. Cut defense, cut social programs, raise taxes dramatically, or accept high inflation for money printing. All options are politically difficult and economically painful. Dollar value throughout 2026-2030 could depreciate 15–25% from current levels as structural support from trade and reserve demand erodes. Imports would become much more expensive. Living standards would decline. American economic dominance that's existed since 1944 would end not through military defeat but through financial displacement. China throughout 2026-2030 would emerge as alternative financial center alongside U.S. yuan would be widely used for Asian trade. Chinese banks would be global players. Chinese financial markets would deepen. China's economic power would translate into financial power in ways that weren't possible when dollar was monopolistic. Now let me tell you what I personally think is happening. U.S. throughout 1944-2020 benefited from extraordinary currency privilege that wasn't natural or permanent, but resulted from specific historical circumstances. Bretton Woods Agreement, petrodollar system, lack of alternatives, U.S. economic dominance, trust in U.S. institutions. Throughout 2025, many of these foundations have been eroded. U.S. fiscal irresponsibility with $36 trillion debt, U.S. weaponization of dollar through sanctions, Chinese rise creating alternative economic center, technology enabling alternative payment systems, multipolar world replacing U.S. dominated order. China and Russia throughout 2022-2025 have been systematically exploiting these developments to build alternative financial architecture. They're not destroying dollar. They're building alternatives that make dollar optional for growing percentage of global trade. U.S. power faces its hardest collapse throughout 2024-2025 as dollar reserve share falls from 71% in 2001 to 57-58% currently, with pace accelerating to 1 to 2 percentage points annually. China and Russia push global markets into post-dollar future by building SIPs processing $25 to $30 trillion, currency swaps worth $600+ billion, BRICS bridge connecting major economies, and bilateral arrangements enabling trillions in non-dollar trade. Approximately 25-30% of oil trade now occurs in non-dollar currencies by late 2025. Roughly 15-20% of global commodity trade avoids dollars. Asian manufacturing trade increasingly uses yuan or local currencies. Each month throughout 2025, more transactions flow through alternatives rather than dollar systems. As 2025 ends, U.S. faces trajectory toward fiscal crisis as borrowing costs rise with weaker dollar demand, loss of sanctions effectiveness as alternatives exist, and potential military retrenchment as fiscal constraints bind. China and Russia throughout 2025 accelerate alternative infrastructure build-out that will define post-dollar financial order of 2030s. The collapse isn't sudden or dramatic. It's relentless monthly erosion throughout 2024-2025 of structural dollar demand from reduced reserve holdings, alternatives to dollar trade, and shifts toward multipolar currency system. U.S. power that rested on dollar dominance for 80 years faces its hardest collapse not through military defeat, but through financial displacement as China and Russia successfully construct parallel system that works well enough for enough countries to permanently end dollar monopoly on global trade and reserves.